Morning everybody. Today we are going to discuss about first in first out method. The first in first out method, it is a method of inventory valuation is based on the assumption that the sale or usage of goods following the same order in which they are bought. In simple terms, under the first in first out method, the earliest purchased or produced goods are sold or removed and expensed first. In FIFO method, it is called lost in lost out method. It is an inventory valuation method where the most recently acquired items are sold or used first. This approach can impact financial statements and tax liabilities by reflecting current cost more accurately during periods of inflation. Let us go to the sum. The stock of a material as on 1st April was 200 units at rupees 2 each. The following purchase and issues were made subsequently. We have to prepare store's ledger account showing how the value of issues would be recorded under FIFO method and LIFO method. April 5, there was a purchase 100 units at rupees 2.20 each. April 10, another purchase was made 150 units at rupees 2.40 each. Same April 20, there was a purchase made at 180 units at rupees 2.50 each. April 2, there was an issue at 150 units. April 7, further issues were made at 100 units. April 12, issues 100 units. April 28, issues were 200 units. Let us go to the sum, how to apply first in first out method. First we have to prepare a tabular column, first a date column, receipt column, issue and a balance. We have to prepare like this. In receipt column we have to prepare three items. One is quantity, rate and amount. Both issue and balance also we have to prepare like this. In quantity, units, there was a units given in the sum that should be recorded in the quantity item. Rate in purchases, there is a rate is given, that rate should be taken for receipt column, and both we have to multiply quantity into rate, put it in the amount column. In issue, quantity is only given in units. We have to find out what is the rate we have taken. After that we have to multiply quantity and rate. The amount should be recorded in record column. Balance item, the first balance was given in this sum, that is called opening balance. 1st April, there was a 200 units at rupees 2 each. If this is the opening balance item, it should be recorded as the first balance. April 1, 200 units at 2 rupees each. The value should be 200 into 2 equal to 400. So next we have to go to the chronological order. April 2, there was a issue 150 units. In April 2, we have to use in first out method. There is only one balance. We have to take 200 out of 150 units. 150 units should be recorded in issue item, and the rate balance rate should be taken. 150 units into 2 rupees equal to 300 value. Next we have to find out the balance and record in the balance column. Out of 200, 150 units should be issued, so the remaining balance is 200 minus 150 equal to 50 units. The same 2 rupees should be taken. 50 into 2 equal to 100. So next April 5, there is a purchase 100 units at a 2.20 each. 100 into 2.20 equal to 220. We should record in the amount column, and this should be recorded in the balance column. This was the second balance. Already there is a balance in the last April 2. So 50, 2 rupees, 100, and the second balance should be taken 100, 2.20 value 220 rupees. In April 7, there was a issue 100 units. So we have to apply first in first out method. First we have to take the first balance in 50. We have to take out of 100 we have to take 50 units. 50 at the same value 2 rupees to be taken. 50 into 2 equal to 100. The remaining 50 we have to take in the next balance. Out of 100 we have to take the 50 units at the same value 2.20 equal to 110. Find out the balance in the balance column. The remaining 50 at the same value 2.20, the value should be 110. Next April 10 purchase. Purchase should be taken 150 units at 2.40. 150 into 2.40 equal to 360 units should be recorded, and write the balance column. Already we have the old balance. Take down the old balance and write down the new balance also. In April 12, there was a issue 100 units. We have to apply first in first out method. First we have to take the first balance. Out of in April 12 100 units out of 100 units, we have to take the first balance 50 at the same value 2.20. The value is 110. The remaining value should be taken the next balance, that is called 150. In 150 we have to take 100 units at the same value 2.40 equal to 120. Find out the remaining balance and record in the balance column. The remaining balance is 150 minus 50 equal to 100 at the same value 2.40 equal to 240. And next April 20 there was a purchase. In April 20, write 180 units at 2.50 equal to 450, and it should be taken in the next balance. The first balance is old balance 100 and the next balance is 180 rupees. 180 quantity at 2.50 equal to 450. In the next entry, April 28, there was a issue 200 units. We have to apply first in first out method. The first balance is 100. In 200 we have to take 100 units in the first balance, 100 at the same value 2.40 equal to 240. The next balance should be taken the remaining units. So the remaining 180 out of 180 we have to take 100 units at the same value 2.50 equal to 250. Calculate the balance in the balance column. 180 units minus 100 equal to 80 and rate equal to 2.50. The value is 200. So final we have to record stock at the end, 80 units valued at rupees 200. So this is called FIFO method. Thank you.